Hi guys, I welcome you to this very interesting topic, depreciation. You will learn as to what depreciation is, how it is calculated, and how it is presented in the financial statements. Before I proceed, I request you to subscribe to my channel, click the bell icon. When a business purchases non-current asset such as a building, plant and machinery, equipment, furniture or fixtures, office equipment, motor vehicles, computers. So these are all types of non-current assets. Then the cost of the asset is capitalized. What is meant by capitalize is that the cost is recorded in a particular asset account. And the example in the next slide will illustrate this point. So let's take an example that a computer is bought for $1,200 for office use. So this is very important that the asset is bought for use in the business. It's not bought for resale. So there's a dividing line. If an asset is purchased for office use, it's a non-current asset. But if a computer is bought for sale, then it's part of inventory. So one has to be very careful here and read the statement very carefully to establish that this particular purchase is for office use in the business. So now the accounting entry to capitalize the cost of the asset is shown here. And as you can see that a computer can be part of office equipments and the amount is stated there as a debit. And then accounts payable is credited. As you know very well that accounts payable means that you have to make the payment later on. So now as you have seen that we bought a computer and the cost of the computer was recorded through an accounting entry in our books of accounts. And now we come to the topic of depreciation. And what happens that a proportion of the cost is charged to income statement as depreciation expense. How this is done is shown in the next slide. So what is depreciation? Actually, depreciation is the proportionate cost of a non-current asset that is charged to income statement. So the accounting entry is a debit to depreciation account and a credit to accumulated depreciation account. Okay, now I'll talk about the method for calculating depreciation. And if you refer to any book on accounting, you will find several methods shown there, 6, 7, 8 different methods of calculating depreciation. But the two more popular methods are shown down below. The first is a straight line method and the second is diminishing balance method. These two methods are more common and I'll discuss these two methods in detail in the following slides. So the first method is known as straight line method. What happens here is that we take the cost of the asset, we deduct residual value and then divide the remainder by the life of the asset. So how this is done is shown in the example. Next slide. So an example follows showing the calculation under a straight line method. So let's take an example that a computer is bought for $1,200 and its estimated useful working life is 4 years, and it is estimated that after 4 years the computer can be disposed for $200. So $200 in this case is the residual value. And the calculations of depreciation are shown here, that we deduct the residual value from the cost of the asset and then divide the remainder by the life, that is 4 years. So we divide the remainder by 4 to get $250 as depreciation for 1 year. So $250 per annum is the depreciation of the computer, and $250 will be charged as depreciation in the accounts. So the accounting entry is shown down below. We debit depreciation and we credit accumulated depreciation. So now the $250 that we calculated as depreciation will be repeated over the life of the asset. So in this case, the life of the asset is 4 years. So $250 will be charged as depreciation for year 1, again for year 2, again for year 3, and finally for year 4. So each year we'll prepare an entry for $250 as depreciation for the year. Now I will talk about the other method, which is diminishing balance method. This method is also referred as reducing balance method. So don't get confused when you see the other term, which is reducing balance method. So in diminishing balance method, we estimate a percentage rate for charging depreciation, and this percentage rate is charged to the balance of the cost of an asset, and that is how depreciation amount is computed, and I will show this in the next slide. So this slide shows the computation of the rate for charging depreciation, and the calculator that is used is Texas Instruments Model BA2 Plus. The first action is to pick up the salvage value or the residual value of the asset and divide the salvage value by the cost of the asset. So that is our first action. And then the second action is to enter this value that was calculated by dividing salvage value by the cost. Enter this value in the calculator. Action 3 is you have to press the key Y, X. The fourth action is enter the life in the calculator. So the life, whatever is the life of the asset, 4 years, 5 years, 10 years, that is entered in the calculator. And then fifth action is you have to press this key 1 by X, and then you have to press equal sign, and this will give the root. And the final action is deduct the root from 1 to get the rate for computing depreciation. And here is an example for you to clearly understand all the calculations. And you need to practice this to get a hang of it. So if the cost of the asset is $10,000 and the salvage value is $256 and life is taken as 4 years, the first step, you divide the salvage value by the cost of the asset to get the figure that is 0.0256. You have to enter this in the calculator, and then you have to press the key YX and then enter 4, that is the life of the asset, in calculator, and press the key 1 by X, and then press the key equal sign to get the root as 0.4, and then finally deduct 0.4 from 1 and multiply by 100 to get the rate 60%. So in this case, the rate for charging depreciation is 60% of the cost of the asset. Normally, the rate for charging depreciation is given in the questions, so you won't have to worry too much about the calculation of the rate because it's a complex exercise. Now this example gives you the cost of the asset at $2,000 and the rate for depreciating this asset is 20% per annum. And now you can see the first year depreciation is charged at 20% of $2,000, that is the cost of the asset, and the amount of depreciation is $400. In the second year, 20% is charged on $1,600. That was the balance of the cost remaining after charging first year's depreciation. So the balance available in the second year is $1,600, and we apply 20% on this figure of $1,600 to calculate depreciation at $320. So $320 is the depreciation charge for the second year. And now we come down to third year, and in third year the balance of the cost available is $1,280, and we apply the depreciation rate 20% on this amount to calculate third year depreciation at $256. And we can go on doing this for as long as the life is stated in the question. So if it's 4 years, that is the life of the asset, then we calculate the depreciation for 4 years. And few things to remember, that the percentage rate is applied on the balance of the cost each year to compute depreciation, and the amount of depreciation keeps declining each year, as you have seen in the previous slides. That is an interesting feature of diminishing balance method. Now, there is more logic in it, that the output from the asset keeps declining as the time passes by, and so is the depreciation charge in the accounts. Now, depreciation is a complex topic, and there are so many interpretations and possibilities of errors in accounting, in computation of depreciation, and so on. So the Inland Revenue Service, IRS, has provided a table where it has stated the life of various types of assets and the depreciation rates. And the earlier years show a higher rate for calculating depreciation, and in the subsequent periods the rate keeps declining. So the idea is to give maximum benefit to the investor in the earlier years of the purchase of an asset, and then as the time passes by, the rate keeps declining. Now the table, there are two tables, they are very important. The first one is ACRS, that is Accelerated Cost Recovery System, and then it was later modified and it's known as MACRS. So these tables are handy and they can be used, and the rates can be picked up from these tables to calculate depreciation on various types of assets. Now I'll talk about how depreciation is treated in accounts. So as you know very well now that there are two accounts that are activated in the entry for charging depreciation. The first account is depreciation account and the second account is accumulated depreciation account. So the depreciation will appear in the income statement as an expense and the accumulated depreciation account will appear in the statement of financial position. The previous name for this statement used to be balance sheet. The new name is statement of financial position. So the accumulated depreciation account balance, and remember it is the balance of the account. It is the cumulative balance amount that is taken to a statement of financial position, and the next slide will show you the presentation in the statement of financial position. So this is just an extract from the statement of financial position. We have various types of non-current assets classified on this statement like land, building, plant and machinery, furniture and fixture, office equipment, motor vehicles, and so on. So in this case, we are taking the asset to plant and machinery and we show the cost of the asset at $400,000 and then we show the accumulated depreciation. Remember, this is the balance in the account, $120,000. So we deduct $120,000 from $400,000 to give us the net cost of $280,000. Now remember that each type of asset, non-current asset, will have a presentation like this on the statement of financial position. So what happens is that we add the net cost of the various types of assets to give us the total value of non-current assets in the business. Well, I hope you got a fair idea of what depreciation is all about. And please remember that depreciation does not involve any physical movement of cash. That means depreciation is not an amount that is paid to any party inside or outside of the business, nor it is an amount that is received from any party in the business. So there is no physical movement of cash involved when we come to depreciation. This point should be very clear in mind. The second point is that it is only an accounting entry. And what this accounting entry does, it transfers a proportion of the cost of the asset to depreciation as an expense. So now I want you to focus here that when we purchase the asset, we make the payment for the asset. So money has gone out of the business. And then what we are doing, we are simply transferring a part of that cost to depreciation each year over the life of the asset. And remember that depreciation is closely linked to the tax liability of a business. So when we show depreciation in the income statement, naturally it reduces the net income of the business. And then when we apply the tax rate on the net income, naturally the tax liability reduces, is slightly reduced because of showing depreciation in the income statement. So this aspect is very important, and just bear in mind that depreciation and tax are two terms that impact each other. And then we say goodbye to you. Now, this topic of depreciation is slightly complex. but I tried to make it more clear to you so that you get a hang of it. And if you have any difficulty, any problem, or any comment, my email address is there. You can contact me, and also try to connect to my channel. I'm at Saadat Kirmani, and also I'm at Accounting Finance. So either of the two channels, connect with me. And I say thank you to you now. Bye for now. See you around.